On this morning's Ag Issues program. A pleasure, as always, to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. 12 degrees, really?
Yeah, I know.
Oh.
I keep looking at the calendar and it says October 30th, and we've got that type of temperature already. So I don't want to say it's a harbinger of what is yet to come winter-wise, because I don't want to think that far out.
Yeah.
But I hate to say we're overdue, but we are.
Yeah.
All right, let's get to it. This is starting out with new corporate reporting requirements. So this is specifically that if you have a farm that is structured in some form of business entity that must be filed within the state, there is a, come January 1st of 2024, there's a new reporting requirement that starts at that date that might apply to many of you.
Yeah, that's right. And this is something that we've been watching for some time, because this was part of the Corporate Transparency Act that was enacted back in 2021, but it wasn't set to take effect until we had regulations in place that then would set the effective date. Well, that date's coming January 1. So now we have to worry about this, because there are some very, very substantial fines if there's non-compliance, if the reporting hasn't been done. So I think we need to go through this, because this is going to apply to a number of, quite a few farming operations that are out there. What this is, Greg, is something that's coming out of what's known as the Financial Crimes Enforcement Network. Now, that's not IRS, but they work closely with the IRS, and this is an anti-money laundering deal. This was enacted to combat fraud and money laundering and other illicit activities. It's designed to capture more information about the ownership of specific entities operating in or accessing the U.S. market, but it's going to sweep up farming operations in that. And so that's why we've got to worry about this and start talking about it. And primarily, what it's after, we've heard a lot in the news the past few months about the creation of shell companies to hide money from the IRS, and that's what this is after. Those that are, that's kind of the first tier of really what has triggered this. Now, the problem is when the government comes up with a regulation like this, it's going to have a broader reach than just those people that are using shell corporations to avoid tax. So let me walk through. That's a little bit of the background. So farmers need to pay attention to this. Let's start with who needs to file first. And the law defines it as domestic reporting companies, and they distinguish that from foreign reporting companies. So if you're a reporting company, you have to file a whole bunch of information, and I'll go through what that information is. Now, one thing I would note that is important is if you're a sole proprietorship and you don't use a single member LLC, you're not considered to be a reporting company. So that's a key point. If you're just a sole proprietorship, mom and pop farming operation, you're not deemed to be a reporting company. But if you've done any type of estate planning, transition planning, succession planning, you've got an entity as a part of your farming operation, whether that's a corporation, whether that's a partnership, whether it's a limited liability partnership, maybe it's a business trust, those types of things, then you better pay attention because there's something that you're going to have to file with FinCEN starting perhaps January 1, 2024. And they've got staggered dates here that will also apply in terms of when the information is going to have to be filed. For example, I'm going to have to file myself for my own S corporation. So we have to pay attention to these things. And this is catching a lot of, I think, Greg, it's catching a lot of farmers flat-footed. It's not something, I'm sure you haven't reported on this in the farm news because it's something that's kind of out there and it's esoteric and it's not high profile. It's not sexy news, so to speak, but it's really, really important. So if we dig into this a little bit, there are a bunch of exemptions. So let's focus on the exemptions. If you have, and this is weird, the way this, you might think it's weird, and I'll explain why it's set up this way. Most of the time we would think, well, if I'm a small operation, I'm not caught by this government reporting net that they're throwing out here. This is after the big boys that are creating, as I said, these shell corporations to hide money and not pay tax, and that's not me. I've got 500 acres or 1,000 acres. I'm farming operation. I'm just minding my own business in Kansas or Nebraska or wherever. Here's the exemption. If you have at least 20 employees and report at least $5 million on your latest filed tax return, and you have a physical presence in the U.S., you're exempt. Okay. If you're under those thresholds, you're not exempt. So and that seems weird, the way this is set up like that. Why are we excluding the big operations and the little operations have to report? Well, the big operations are already subject to reporting to the SEC. And so the government's not worried about those. What they're worried about is those that are beneath that threshold don't have the mandatory SEC reporting. They can't figure out who the owners of these operations are, what their money, how much money they're reporting, and who all the players are. And so that's why it's catching smaller operations. And that's why we're really concerned about this for those smaller farming operations. Now, even if you are a farming operation that is exempt because you have 20 employees and you report at least $5 million on your latest filed tax return and you're in the U.S., you still may not be exempt, because for those large operations like that, what we like to do is structuring of the business so that we've got one entity that might be an operating entity, say, for example, for government farm program payment participation, and then we've got leases to sub-entities. So we might have a self-rental situation. We might have a farming partnership where each of the partners owns their interest in the partnership in their own limited liability company. Well, in those situations, while your farm itself might be exempt, those other businesses that are tied to that farm, those LLCs that the partners own their interest in, they're going to have to file. So you might have an equipment LLC or a land LLC, or you might have some other type of related entity. And it's in those situations where you have one large farm entity that won't exempt the sub-entities. And so it's a mess, Greg. Farmers and ranchers have to be aware of this, and then we can get into the penalties here in a second. That'll really illustrate to people how important it is to pay attention to this one.
Yeah, and it's, I won't say an obvious case of unintended, or it could be an obvious case of unintended consequences, but as you mentioned, I'm sure the penalties are going to be pretty steep if you do get caught up in this.
Yeah, the penalties are horrific and can really just put you out of business. But before I mention that, here's the stages to the time at which you have to file. If your business was in existence as of the effective date, which is going to be January 1, 2024, so you're already in business, you have until January 1 of 2025 to file your initial reports with FinCEN. If you're created during 2024, then you have 30 days after receiving notice of your creation, or 30 days from the time you register with the state. However, that has since been bumped to 90 days for entities created or registered in 2024. So if you're already in existence, your date's January 1, 2025. If you're going to create an entity in 2024, you got 90 days from the time you register with the state, Secretary of State's office, to file with FinCEN. If you're created after 2024, then it's 30 days. And so those are your tiers to this. Now, what you're reporting is called beneficial ownership information. Who owns the entity, what's their percentage share of the entity, those types of things. And there's a form that has to be completed. And so people can download that form and take a look at all that information that is required to be on there and get ready to report that information according to when your applicable date kicks in. And FinCEN's going to they're supposed to set up a database to hold all of that information. But you're right, the penalties can be very, very severe. We're into thousands upon thousands of dollars per day of violation if you violate these rules. And so that's a very important point to keep in mind. You don't want to mess around with this at all. Noncompliance is going to trigger those high penalties. Possible imprisonment is associated with this. The escalating fines are going to range from $500 to $10,000 per violation and jail time of up to 2 years.
best piece of advice, contact your tax preparer if you've got any questions whatsoever?
Well, the question is whether the tax preparer who's not an attorney can file these documents. We're not sure about that yet. It may have to be an attorney that does this. We're waiting for clarification with respect to this. The question is whether this constitutes the practice of law. If it constitutes the practice of law, you can't have a tax professional that's not an attorney file this stuff for you. But what I'm suggesting is, and what I talk about at my seminars, is that when you create a new entity, this is now another step that has to be done at the time of the entity being created. If you already have an entity in existence, then you better be talking to your attorney as well as your tax advisor to make sure you got all the appropriate information ready to be filed when your trigger date occurs, when those forms are due. I don't like talking about stuff like this. It's just another government requirement that's out there that's going to apply to a bunch of farmers, but this one's got a whole bunch of teeth in it, and so people have to be aware of this. We're definitely going to be talking about this at the K-State tax schools. That we have a first online one on Thursday and Friday this week, and then we hit Garden City and Hayes next week, and then on from there.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us this morning. Well, Roger, over, say, the past year or so, we have seen many employee retention credit claims that have been filed, but a lot of them end up being fraudulent claims, and it sounds like it's gotten so bad that the IRS has stopped processing claims for the fourth quarter of 2023. So if you are a farming operation, likely that probably didn't qualify for the ERC but may have submitted the claims, IRS, I guess, has provided a path for those who want to withdraw their claims?
Yeah, they have, Greg, and this has been a real mess, and I'm sure that people have heard it, advertisements either on the radio or they've seen it on television of these firms that are saying, well, that they'll process an ERC claim for you, the employee retention credit. And it's just been riddled with fraud, and IRS just said a few weeks ago that they were going to shut down processing of these claims for the fourth quarter of 2023, which is really difficult on those smaller businesses that filed legitimate claims and are in need of the funds to keep operating. Of course, this came out of the virus situation a couple of years ago, and now IRS has said, all right, we're going to basically create an amnesty program here. If you think now that you have been duped into filing a claim, or you knew that you filed one and weren't deserving of the funds, and this could include farming operations being duped into this, because you have to have a decline in revenue of at least 20% in your gross receipts on an aggregated basis to be eligible for this. Well, a lot of farmers didn't have that. In fact, revenue might have gone up for farmers during the virus years. And so most farming operations are not going to be eligible for this. So what IRS is saying here is, all right, if you filed a claim, we're not processing right now, we're going to give you an avenue out, because if we come after you when we start processing these again, you're going to have substantial penalties, and life's not going to be nice. And so even if you're under audit on this currently right now, they said you can withdraw your claim, and everything's okay. No harm, no foul in that instance. You have to file a Form 943 and write withdrawn on the left-hand margin and sign and date the form before you send it into the IRS. And that's the same if you're under audit. You just give the signed form to your examining agent. So it's an amnesty program. It's a way out if you now have discovered that you may have filed a fraudulent claim.
And so if they're able to do that, or if they want to do that, are there specific forms that they need to look at specifically, or things that they need to write on those forms?
Yeah, 943, and just write withdrawn on the left-hand margin, and make sure you sign and date it before you send it to the IRS. And you can even do that if you're under audit. Just do the same thing, same form, but give the form to your auditor. If you received a refund, but you haven't cashed it, then write void and ERC withdrawal on the check, on the refund check, and send it back to the IRS, and you're still good in that instance.
All right, let's move on. Simple question of one of the topics you want to discuss is how much gain on land can be excluded under the home sale rule?
Simple answer, it depends. What we have right now, of course, if you sell your principal residence, once you've lived in it and treated it as your principal residence for at least 2 out of the last 5 years, you can exclude up to $500,000 of gain on that sale on a joint return. It's $250,000 of exclusion of gain, not value of the home, but gain on sale on a single return. And so we get this question a lot. Well, if I sell land, farmland with the home, can I include any of the gain associated with the land with the resident and fill up that $500,000 exclusion? Let's say maybe I only have $200,000 of gain on the home. Well, that leaves me $300,000 less. Can I wrap any land in with it? Because I'm selling an acreage, maybe I'm piecing off some of the farm, or I'm selling the farm with the house. Can I fill up the rest of that $500,000 exclusion on my joint return with my spouse with gain associated with the real estate? The answer is it depends. You have to use the land in association with the real estate. So, for example, if I have a garden and I'm growing produce that I'm using in the household, or I've got landscaping, areas that are landscaped that to fit with the home, we can roll that in too. So you might get a couple of acres in. It just depends. Do you have outbuildings that are used in connection with the home, such as a garage that's an outbuilding? Do you have a workshop that's used with the home? Those types of things is what the courts will look at. So the answer truly is it depends. What is treated as being used with the home and what is not. Now, if you farmed it, that's not going to count, because that's not used as your principal residence. That's used as a farm. But you might have an acre or two that you can roll in with that house to exclude the gain associated with that and increase the tax benefit to yourself.
And one other thing I want to talk about, this is concerning farm leases and whether they'd have holdover tenancy or not. This is on written farm leases, I should say, as well, when they have the expiration date. I know a recent court case rendered a decision on that.
Yeah, when you sign a written farm lease and it specifies what the end date on is in that lease, you don't have a holdover situation. And that's what happened in this case. Came out of Lynn County. It had a fellow that signed a lease in January. It was for a year, and it was terminating on December 31. Well, he gets into the next year, the land gets sold, you have a new buyer that comes in and has a new person that hays the ground and finishes haying the ground and getting it baled late at night one night, and early the next morning, here comes the previous tenant in and takes the bale. So it was a setup. He was clearly monitoring this to come in and swipe the bales. And he did. The new owner calls the sheriff, calls the authorities, and the guy is told, don't come back here and do this again. Well, he did. He gets prosecuted criminally, gets a diversion for his theft of the hay, and ends up paying the new landowner $27,000 for that. And he tried to argue that, well, I was a holdover tenant. And the trial court, as well as the Court of Appeals in Kansas, said, no, you're not. You had a written lease. You knew when that terminated. It did have a provision in it that said that the parties could agree in writing to a written extension of this. That was never done. And so this never went to trial. It was dismissed by the trial court as a matter of law. And the appellate court in Kansas said the trial court was right. So it just comes down to don't do stupid stuff and don't do stupid criminal stuff. And it's just unfortunate we see these types of cases.
Well, Roger, as always, great conversation. And if people want to know more, including the upcoming schools or starting of the tax schools here later in the week, what's the best way they can find all the information?
Well, there's a couple of ways on that. My blog, which can be accessed through the homepage of my website, which is washburnlaw.edu/WALTR, and then over at K-State Ag Manager website through the Department of Ag Econ.
All right, sounds good. Roger, as always, I appreciate it. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.